who is this video good for? Well, first of all, I think it's good for anybody looking to buy a home, so that's an easy one. Second group of people this video is for. It's for loan officers. So if you're looking to buy a home and you're wondering, do I qualify? What do I qualify for? I spoke to somebody and they did not explain everything, and you're confused, or I've never done this before, I don't know what I'm doing, this seems scary and complex and hard, whatever. Good, this video is for you, okay? What I'm going to talk about today is just qualifying for a mortgage loan. What does it take to qualify for a mortgage loan? This stuff applies no matter where you go and no matter who you talk to. It doesn't matter who the lender is. It doesn't matter where you are. To buy a home today, to qualify for a mortgage loan, it takes three things. Number one, it takes credit. Number two is income. Number three, it takes money. Doesn't matter where you're buying again. It could be Florida, it could be Nebraska, it could be California, it could be Oregon, it could be Washington, it could be anywhere, okay? Louisiana, Mississippi, any place in this country, Hawaii, whatever. Credit. Credit determines if you can get a loan. Doesn't matter how much money you have, doesn't matter how much money you make, doesn't matter if you're a brain surgeon, what position you hold, who you are. If you do not have the credit, you are not getting a loan. Credit determines if you can even get a loan. The second thing, income. Income determines how big of a loan you can get. Money, it takes a little bit of money. Whether it's a down payment, whether it's an appraisal, and you have to prepay for homeowner's insurance, you need to get a home inspection. It takes a little bit of money. You have to cover closing costs. So money, that's the third part of the equation. Credit, income, and money. Credit determines if you can even get a loan. Income determines how big of a loan you can get. Money, it takes money to cover a down payment, closing cost, and some of the incidentals. You know what the cool thing is about my job? I've done this for 22 years. 22 years ago in 1999, if you wanted to buy a house, it was credit, income, and money. In 2005, credit, income, and money. In 2009, during the mortgage crisis, the mortgage meltdown, the subprime crisis, all this craziness, that's when foreclosures in the United States went to an all-time high since the Great Depression, as a matter of fact. Credit, income, money. Dodd-Frank came in, overhauled the whole industry. We have new guidelines, new paperwork, new documents, new everything. You know what the cool things about my job? It's credit, income, and money. Don't make it any more complicated than that. This job becomes difficult because people give bad information to consumers. So you set the wrong expectations, and the next thing you know, you're sitting here with bad information. People get upset, they get frustrated, the stress starts pouring down on you, you start not knowing what in the world's going on, and then we're in a bad place. Keep it this simple. Anytime a consumer says, I've never done this before, the translation of that statement is please educate me. Instead of just smashing them with numbers, educate them. Now let's take a little bit of a deeper dive. When it comes to credit, there's two parts to credit that we look at, okay? There's the credit score and there's the credit history. So let's take a deeper dive. When you check your credit, there's the score. Hash, I have a 702, I have a 631, I have a 591, I have a 480, I have an 804. That's the score, okay? This is only one part to this part of the equation. Remember, this is the equation. Credit, income, money. I wish it just ended right there, okay? I wish it just ended right there. It doesn't end right there. Credit breaks down into this section. There's two parts to credit, okay? We look at the score and we look at the history. We look at the score, we look at the history. The score is the number you get. This is what the history is. Credit history. Have you had a bankruptcy? Do you have any collections? Do you have any late payments? Do you have any judgments against you? How many student loans do you have? Are the student loans in deferment? What exactly are we talking about when it comes to the actual accounts on your credit themselves? These are treated, and listen to my words on this one, they're treated independent and separate. You've got to understand those two words. Let's pretend you have a 705 score. Let's pretend you have a bankruptcy, a Chapter 7, that's only 1 day old. Okay? You're 1 day out of a Chapter 7. On traditional loans, which encompass 80% of the loans done in the United States, that's VA, FHA, USDA, and conventional. On traditional loans, you and I have a bankruptcy discharge within the last 2 years, okay? That's for FHA, VA, USDA is 3 years, conventional is 4 years. You might have the score that I need But if you fail in the credit history section, you are done. You're eliminated. That means that you strike out right here on step one. I'm not even wasting my time or your time going through income and money. We're not even doing it. It makes no sense, okay? Let's go over income. There's two parts to income that we analyze. Just like when it comes to credit, there's two parts to credit we analyze. There's two parts to income we analyze. When it comes to income, we analyze the amount of income and the source of the income. You've got to keep this in mind. I'll give you an example. If you say I make $60,000 a year at your job, that's wonderful. But if you've only been working on that job for one day, that's not that great. Now there's what are called exceptions to this, but again, through all of my videos and everything I do, we take deeper dives on individual things. I'll give you an example. If you said, Hesh, I'm one day on the job, but I just graduated nursing school and I just started working at the Mayo Clinic yesterday or today, fine, we will use your time in school as your employment history, the source of the income, and we're fine with one day on the job. So there's exceptions to the rule, so don't panic. But what you need to understand is we don't just look at how much money you make. As an example, I don't just look at your credit score. Just because you have a 705 doesn't mean you're getting a loan. I've got to see what your credit history looks like. That's just to get beyond step one, okay? When it comes to income, we look at the amount of the income and the source of the income. I can't tell you how many people I talk to, especially for the loan officers watching me. This is the number one mistake loan officers make. This is the number one mistake that loan officers make. Number one, they just use the money. They don't even look at the source. They just say, hey, the guy makes 60 grand a year, I'm good. That is not good. That is bad. That's how you run into problems later. If you are a young loan officer and if you're an old loan officer, you've got to pay attention to the amount and the source. Okay, it's the amount and the source. Now watch this one. I'm going to cross off income and I'm going to write in money. Okay, money. The third step to the equation, money. Okay? When it comes to money, take a guess what we do. We look at two things, the amount of the money and the source of the money. Okay? I'm going to look at how much money do you need to close. If I tell you you need $10,000 to close, guess what? You need $10,000. If I tell you you need $100,000 to close, guess what? You need $100,000. I look at the amount and I look at the source. When it comes to the money, if I tell you need $60,000 to close and you say, Hesh, the source is cash, it's in a briefcase, it's sitting underneath my bed, okay? That is not an acceptable source of money. Cash is not acceptable. In extremely few circumstances, cash is usable. Ridiculously few, and right now I will not even go through what the few are. That's for another video. But do you see how I get you coming back to these videos all the time? Anyways, so we look at the amount of money you need and the source of the money. If you say, Hesh, the source is my parents, okay, fine. We're good with that. Hesh, the source is cash, can't use it. Hesh, I don't know what the source is, I can't prove where it came from, can't use it. So when it comes to income and money, we look at the amount, we look at the source. This is what we look at. So these are the three things it takes to qualify for a loan: credit, income, and money. Credit determines if you can even get a loan. Income determines how big of a loan you can get. It takes a little bit of money to cover your down payment, your closing cost, appraisal, inspection, insurance, some of the incidentals I call it. When it comes to credit, there are two parts that we look at. We look at the credit score, we look at the credit history. When it comes to the income and the money, there's two things we look at. We look at the amount and we look at the source. All of this is critical into getting a loan. If you're a loan officer or somebody buying a home, pay attention to these. Naturally, I'm a loan officer. I have a pretty good idea of what I'm doing, and I'm doing loans. So if you need to buy a house or refinance anywhere in this country, well, I'm licensed in 43 states, not in all 50 yet, but I'm getting close to it. Give me a call also. Talk to you later. Follow these videos. Thanks so much.